right now. Hello, everyone. Welcome. We are live today. This is our episode 4, Learn How to Options Trade for Beginners. And before we begin, I would like to have an introduction from our panel and guests. So why don't we start with you, Guillermo from Finance ABC?
Yes, that's right. My name is Guillermo Bermudez. I'm from Finance ABC, and my channel is all about financial education. And after working in the financial services industry for 30 years, I decided to give back some to the community. And I thought, well, why not financial education? I've started this channel over a year ago, and I've been talking about how to save and invest in the stock market, and also about options. Options can help you increase the yield on your portfolio, and it gets a bit complicated for the beginner investor. So the good news is that you don't really need to do options to save and invest for your retirement. All you need to do is invest over time and hold, and make sure you invest in an equity index.
Awesome. That was a very great introduction. Steve, why don't you take the stage and introduce yourself?
Okay, hi guys. My name's Steve. I'm from the UK, so I'm the only representative from the UK. Obviously, we've got two people from the USA. So my company is called Disruptive Wealth Creation, and I try and live up to my name. So I invest in disruptive companies that either startups or new companies that have got a lot of potential growth. So, for example, biotech companies, I invest in 3D printing, automating companies, electric companies like Tesla, NEO, XPeng. I'm also interested in space technology, very similar to Kaye, sort of investing in Branson and Blue Orion. As well as that, I also like to get involved in cryptocurrency, and this is something I'm getting more and more interested in, and I always like to bang the drum. So whenever I do my videos, I might do 2 on shares, and then I do another one on crypto, and I'm always thinking about crypto all the time. And my son, he invests as well. He just invests in crypto. He's not interested in shares. I think that's the future, but that's just a personal opinion. So that's me.
That's awesome. Well, I am Invest for Tomorrow with Kaye, and you're watching this live on my channel, hopefully. And if you're watching it afterwards, my channel basically talks about investing in general. And I also, post videos about whether it's your growth investing, whether it's your value investing, whether you're investing in ETFs. But basically, all my channel is promoting is that you should get into investment, whether you like investing in crypto, whether you like investing in options, whether you like investing in general. But that is the message is for younger generation also to start investing as soon as possible, because you will see the benefits of investing. So that is my channel. And today's topic is very interesting because in 2020, when we had the pandemic, I heard it is anecdotal evidence that a lot of people got into options trading. Now, options trading is a very interesting field, and I have very limited experience from how I have been doing options trading, and that's why we have Guillermo on our panel today to kind of walk us through all the beginners. So if you're watching this live afterwards, we will kind of go through some questions for Guillermo, and then Guillermo can also help us, kind of help us identify the basics for how to learn options, how to trade options for beginners. And so why don't we start off with the first question? And it's an open forum. Steve, jump in whenever you feel like. Guillermo, if you want to kind of tell us about when we talk about what is options, people talk about calls and puts, but for a beginner who doesn't understand options, how would you put that?
Well, an option is a contract between two parties, the guy that sells the option and the guy that buys the option. The option gives the buyer the right, but not the obligation, to purchase or sell 100 shares of the underlying security. So if you have an option to buy, that would be called a call option, because you have the ability to call the options to get them. And if you are purchasing an option to sell, it's called the put option, that you can you can push or put the security to somebody else at a set price. That's called the strike price. And those options are for a specific amount of time, and they give you that right within that period of time. Afterwards, they expire and they become worthless if they're out of the money, which means that the strike price is above the market price if it's a put, or if it's a call, the strike price is below. Size it if you could in the open market instead of through the contract. So that's essentially what an option contract is.
Got it. So for beginners who are just starting off, the basic definition of options, when you say call, is basically as a buyer you're calling the contract, and as a seller you are selling, so putting it away.
Putting it away, exactly.
Okay, can I ask a question? The first thing I would say is I first came across the call options and the put options when I heard your video with Leroy from 40 and Broke, and that was a good introduction for me. So I know a little bit about it already. Two questions. What are the sort of percentages when it comes to fees? Because there must be some fees involved in the contract. That's the first question. And the second question is there what's the longest you could have these contracts for? And the reason I ask you this question is if I'm thinking that there might be a stock market crash within the next 6 months, I might want to go for that. They're my two questions.
Yeah, certainly. The options can go as long as a year and even more, 2 years. But the most common options, the most heavily traded options, you can buy an option for 1 month, for 2 months into the future, 3 months, 6 months, a year. I particularly like selling options, not buying them, because when I sell it, I get paid the premium. I do have an obligation, but that obligation can be managed. The risk there can be managed. So obviously, the longer the term of the option, the higher the premium is going to be. Okay. And if the strike price is at the money, at the same price as the market price, then the premium is going to be the highest. The premium for the time value, because obviously, if the strike price is already below the market, so there's an intrinsic value there. So if I give you the option to buy IBM at 120 and it's trading at 130 something, then you already know you have 30, 15, maybe $16, $17 in the money. Okay. So that gets added to the premium. So I collect it when I sell that.
Yeah, but if say, for example, if there's going to be a rumor that there is going to be a stock market crash, won't everybody wanting to be jumping on, and would there be a stop on it, or would it just carry on?
No, it would carry on. Oh, and right. I will caution people to know that don't believe rumors. Okay. Nobody knows when the next stock market crash is going to come, because if they did know, there would be a market. For you to have a market, you have to have buyers and sellers. So prices move up and down all the time. But in general, they move upwards over time. In the short term, sure, anything can happen. Prices could go down 10% tomorrow or 20% for the index. For individual stocks, it could be even more volatile. But the truth is that nobody really knows when a crash is coming. And so the options market, if you're trading in index options, they have plenty of liquidity. Individual stocks, perhaps, if you recall back around February, Gamestop was impossible to trade because everybody was trying to short it, or everybody was trying to buy a put on it. So the premiums were very, very high, and it wasn't economically beneficial to do it. So So that way you put a stop to the market
So
without
for yeah,
uh,
sorry, go ahead. Go ahead.
without actually putting a stop on the market. The price makes it uneconomical, so the trading stops.
Mhm.
Okay, so I'll just carry on with what Steve actually asked. So for beginners, there are generally two types of options, right? We can have a short-term option, could be a weekly contract, monthly contract, and then for the contracts which you mentioned are long-term contracts, maybe like an year or 2 years. What are generally those contracts called? Are they like leap contracts, which generally we hear the word?
Yeah, they're called leaps, but they're just options, just the same. I mean, when you go to your trading platform, you just pick the same call, and it's a call, or if it's a call or a put, and you pick the maturity date, and
Okay.
it's 2 months, 3 months, it's an option. If it's a year, it's a leap. But who cares? It's an option. It's the
Hmm.
same.
I think a lot of, at least on YouTube, we have heard a lot of people talk about leap options, and they do a lot of leap calls moving, an year, 2 years further out for 2022, 2023. So that is a very popular strategy, at least I have heard anecdotally from a lot of people I spoke with.
Yeah.
Now, the next question I actually want to ask, and we'll start off with, why do you think options is a very powerful technique? Because I feel you can really leverage options in your investment journey to build wealth.
That is true. The options give you the ability to control a large number of shares with relatively a small amount of money. So the premium you pay is all you need if you buy the option. Option prices, the premiums generally tend to be 2 or 3% of the market price. So that's for a 1 month option. If you are looking at a 1 year option, it could be as high as 10%. So you can see that the time value has value, and so that's the way it goes.
Can I ask a question? So, can you actually sell options? Because what I'm thinking is, if say for example, I thought Amazon shares were going to go down, and they went down, and then I've got the option to buy 100 Amazon shares. Well, maybe I haven't got the money to buy them. So could I sell my option to somebody who has got the money?
Yes, absolutely. Options
Okay.
are bought and sold before expiration all the time.
All
You
right.
can buy one today, and if the price moves in your favor, you can sell it tomorrow at a profit or within the same day. Of course, I wouldn't recommend that, but it's possible to do it.
Mhm.
Now, just on the same topic, can you talk about a little bit of covered options and naked options? Because those are two words which we have been hearing a lot lately.
Yes, yes. The most popular option strategy by far is selling covered calls. That means that you own the underlying and you sell the calls. And normally you would sell them at a higher price than the market price. That's called a little bit out of the money, say 5% higher or 10% higher. The higher you sell it, the strike price, the lower the premium is going to be. If you sell it at the money, at the same price as the market, the premium is going to be probably 2 or 3%. If you sell it at 5% above, then probably it's going to be 1%. If you sell it at 10%, it's probably one half of 1%. I'm talking about a 1 month option, 2 month option. If you sell a call for a year, then you could probably get about 5 to 10%, uh, selling it 5% above.
Now, that's a very good return if you think about it, right? Because selling a
Absolutely.
covered call, and folks, if you're watching it and you haven't seen, definitely check out Guillermo's channel on covered calls. And you can check out my channel as well. I have a video on covered calls as well. But going back to covered calls, this is one of the most popular strategies I have seen from investors they use. And from my limited experience, and I think this is one of the strategies, if you are getting into options, you should start off with, because first you're owning a value stock. That means that if you don't sell it and you keep it with you, you still own those stocks. And while we're at the covered call, I have also seen that people sell calls, naked calls, where they don't own the underlying asset. And for beginners, can you talk about it on why we should not be doing or we should be doing it, and what to be careful about with naked?
Certainly. When you sell a covered call, you really have two benefits. One, you collect a premium, so that increases the yield on your portfolio automatically. As soon as that option term expires, you get to keep that premium if the option expired worthless, and you get to keep your underlying. Number two, if your stock price on your underlying goes down in price, that premium you collected provides a little bit of a cushion for you. Okay, so you don't lose as much. And then number three, if the stock price goes up to the moon, then your underlying is going to go up, and you're going to sell it, and you're going to make a little bit of money, and you're going to get your premium. So that's a benefit. But when you're selling calls naked, that means without owning the underlying, then you're exposed to a loss if the price goes up in price, because you don't have the underlying to give to the option buyer. So theoretically, stock prices could go up to infinity. We know that's not the reality, right? The most they can go up is, if you're talking about the index, is maybe 5 or 10%. If you're talking about an individual stock or a cryptocurrency, they could go up 10 times in price. So it can be a big exposure. So naked call writing is very, very risky.
Very dangerous. So let me see if I understood this correctly, and that way I'll repeat it what you said, so that if I understand correctly, I'm pretty sure most of the viewers will understand. So when you're writing a covered call where you own the underlying asset, which means that your cost basis, you have those 100 stocks at a certain cost basis. So when you sell a call, 5%, 10%, whatever premium you sell for, when the price hits that, you sell it at that point of time, you have collected the premium and you have collected the profit. When you are doing a naked call, selling a naked call, which means that you don't own the underlying asset. So let's say the stock goes up $10. So you'll have to buy at $10 from the market and then sell your covered call. So you only benefited from the premium technically. And that is why that naked selling is not recommended for beginners, I would say.
Absolutely. Even for advanced traders, I don't recommend it. Because nobody really knows what's going to happen in 1 month, or 2 months, or a year for that matter. So it's risky. It's very risky.
One of the things that I've heard is that a lot of people have lost money because they, the new traders, they've got the mobile, they get the new app, and they want to make quick bucks, and they get themselves into a lot of trouble. So it's just something that we've come across in the UK. I don't know if that's the same in the US.
Yes. Of course, education is the antidote to losing money. If you're going to start trading, if you start trading options and you don't know the risks, you're likely to lose money.
So my next question, Guillermo, is what are some specific strategies? We touched upon covered calls, but what are some specific strategies you think are beneficial for beginners? And let's think from a standpoint, you have a small account, you have a medium account, and you have a large account. So I can say small account, less than $1,000, medium account, somewhere between 10,000 and I guess 50,000, and large account, 50,000 and plus.
Yes, some of the most popular strategies, of course, we covered the covered calls, but it helps if you sort of do a diagram. Let me show you here. I have a little bit of a whiteboard here.
Perfect.
So when you look at options, it's very easy to understand. This is the price of the stock, right? This is 0. This is 100, whatever. Mm-hmm. This is the market price. Okay, if you're buying a call, these are profits and losses. Okay, so you're out the premium, right? And if the price moves in your direction higher, then you begin to make money once you are able to collect the premium that you paid. Okay? If the price stays the same or goes down, then you're going to lose money. You're going to lose money because this is the premium you paid. Okay? So if the price moves in your direction, it moves higher, then you're going to begin to make money as soon as you recover the premium, right? And you're going to make a lot of money if it goes very high. So then what happens? This is the guy that actually buys the call. This is a call. All right. So if you're selling the call, it's the other way around. Okay. So here's the zero. If you sell the call, then you collect the premium, right? This is the market price. And then if the price starts moving up, you begin to lose money. Okay. And of course, if you own the underlying, this loss gets offset by the rising price of your security. So if it moves to here, this loss will be covered by the security. You just give it up and you collect. You get to keep the entire premium. All right. So, all right. So once we have this understood, what a lot of people do, and I like, my favorite trade with options is selling a put. So how would a put look like? The put looks like this is the price, right? So if you're selling a put, let's talk about buying a put first. You buy a put, this is the market price, right? You buy a put, you pay a premium, and then you begin to make money if the underlying goes down in price. All right. So this is the buyer. But then the seller, it looks something different like this. The market price, the seller would collect the premium, right? And then would begin to lose money if the price begins to go down, because you would be forced to buy it at the strike price. Okay? And then it will be worth less. So selling puts is a great strategy because it's very much like owning the stock without having to put out the money. And
Now,
sure,
is this different from cash secured put?
yeah, if you have selling a put and selling a cash secure is almost the same thing, because you need margin in order to be able to sell a put. You could either have the cash sitting in your account, or you could have securities that you could borrow against, and you could use that buying power to perform in case you're called upon. But, they say that selling put, the risk is unlimited, but it's not, because, the stocks can't go below zero, right? So your entire risk, if you sell, for example, a put on Coca-Cola with a strike price of $55, your risk is 5,500 because it's 100 shares, right? Everything in options is multiplied times 100. So that's your entire risk of selling that put. And obviously Coca-Cola is not going to go to zero. I mean, in theory it could, but unless the company goes out of business, it's very unlikely that it does. And it pays you a dividend along the way. So the dividend helps. The dividend is embedded on the premium that you receive. So if you sell a long enough put that has several dividend payments along the way, that dividend should be part of the premium you receive.
So that's a very good question, actually. So when you have let's say a leap call or a leap put, now, so if there's a dividend paying company, all the dividends are priced into the premium itself?
They should be. So all things being equal, if you have a strike price, the same strike price for a call and a put, the put premium will be that much higher because of the dividend.
I see.
So if you sell a put and the price of the stock goes down, you lose money, right? But if you buy a stock and the price of the stock goes down, you're going to lose the same amount of money. Say you buy Coca-Cola at 100 shares $5,500, and the price goes down, you're going to lose money if you own Coca-Cola, and you're going to lose money if you sell the put on Coca-Cola as well.
So selling put is your favorite strategy. That's what you're saying.
It is.
Guillermo.
It is. And sometimes, if you sell a put that is deep in the money, that means the market price is here and the strike price you pick is right here. So you will collect a lot of premium, because part of that premium is
Did we lose
the
Guillermo?
market price is here.
Okay.
Price you begin to make money because the premium is going to decay. So if at expiration the price is around here, that put is going to expire worthless, because it gives the guy the option to sell it here. And if the market price is here, they're not going to exercise it, right? So selling a deep in the money put is a good way to be long a stock without having to put out the money. You actually get paid to buy the stock.
Can
Okay.
I ask a question here?
Right.
I know that this isn't sort of cast in stone, because things can change all the time. But what we've been finding recently is, with a lot of IPOs, they've been going up and up and up, and then as soon as they IPO, they drop. So do you think the put might be a good strategy for IPOs in many cases?
Well, if you buy a put, you're protecting the downside,
Right.
but you're paying the premium.
Sure.
So, right now, if you own stocks, are you buying puts on all your positions? Probably not, right?
No.
And you're exposed to losing money if the stocks you own drop in price, right?
Yeah.
So, one way that people trade options is with spreads. I'm not a fan of spreads, but it's worth to talk about them. Let me show you what it is. The typical spread is you buy a call, right? We said this is buying a call. You buy the premium, you pay the premium.
So that's a debit spread for audience, right?
Right. It's a debit. It's a debit spread because you actually have to pay.
Pay the premium.
But when you buy the call, you pay the premium and you profit to infinity if it goes up in price. But if you sell another call that's a little bit higher in price, say here, then your premium, your price, your profit will be capped at this level, because you would be forced to give the stock to somebody else. You won't be able. You can buy it here, but you have to sell it here. So the reason you would do this is because the premium you get from selling this call further up reduces your cost. Your cost will probably be somewhere around here then.
Right, because you're paying the premium and you're getting the premium for selling.
Right. So that premium you got for selling is going to
Offset
cap your income, but it's going to reduce your cost a little bit. So that's why it's very popular, because you could play, but then I don't like it, because you're really timing the market. You're betting that the price is going to go up. Otherwise, you're going to lose money for sure, because you're paying the premium, even if it's a smaller premium. So on the flip side, if you are, selling a put and you say you have all this expense and risk of it going down to infinity, you might want to buy a put somewhere below, and then it caps your losses, but then it reduces your profit, your potential profit, by the premium you have to pay. And who's going to do this? I mean, in my estimation, if prices are 10% below, that's when you have to buy. And you're going to be buying if you get put the shares. So why go into this?
And this is called credit spread, right?
This is a
Perfect.
credit spread because you collect more premium than you pay out. And what some people do, for example, if you're selling puts and the price moves against you, it moves the price of the underlying moves in this direction, say around here, you're going to have a loss. Uh, and you wait for the option period to expire or to be close to expire. If it's 6 months, you wait in time, you buy back.
I think we lost Guillermo. Can you
Just for
hear
a
me?
few seconds, he'll come back.
He'll come back. Yeah,
Yeah,
yeah, yeah.
yeah.
We can hear you.
Yeah.
Sorry. That if the price moves against you and you're close to expiration, this forward another one for another 6 months, more than enough money to cover the premium and get some more income. And that gives you more time for the prices to eventually rise because eventually prices go up over time. So in doing this, it's better than doing the spread because your profit is higher, and eventually stock prices move higher, right? But if they move lower, then you buy it back and you roll it forward, and that's what they call, typically manage and roll your puts forward.
Okay. So I think as I understand, it's like building I would say a Lego piece. It's like your basic strategies are call options and put options. Then you
Exactly.
put when you buy and sell a call, it becomes your debit spread. You sell and buy a put, it becomes a credit spread. Then you combine those two, it becomes an iron condor or a butterfly condor. I don't want to get into that. That becomes a little bit more for advanced users. But there are a few things you brought up, Guillermo, and I want to ask you this. You talked about margin in one of our discussions.
Right.
Now, for margin, can you talk about is it good for beginners to actually use margin account? Because personally, I don't use margin account. Deliberately, I don't use it. I try to use my cash because I don't want my securities to be called out in case I make a miss on options. But that's just my personal philosophy. But what is your opinion on margin account for beginners?
I have always used margin in my accounts. Of course, I'm not a beginner, but margin is dangerous when you abuse it, but it's very useful to have it because it gives you flexibility. For example, in your margin account, you can't sell options, can you?
In
You need
cash account, you can, yes.
In that cash account, you can only sell covered calls. You can't sell naked calls, can you?
No, you cannot sell naked calls. Absolutely. So I'll give an example from Fidelity. So generally, what Fidelity does is, and I think that's true for most brokerages. I think the first level of approval is covered calls, right? So they don't give you a margin account. Then you have level two and level three. Level two is when you can sell cash secured put, but they will give you a margin account. You can always ask them to remove the margin account. That's always your option. But yes, as you rightly said, if you remove the margin account, it takes your ability to write naked calls or naked puts, or so
Right.
it does limit your
Yeah.
ability.
When you have an account and you have the money invested, say in an index or something, and you want to sell a put, you can do it against your securities. You don't have to have the cash sitting there not earning you any return. And so by selling puts, you can increase the yield on your portfolio. And of course, if you sell the puts, 5% below the market for 6 months, it's very likely that that is going to expire worthless if prices continue to remain stable or go up, or just languish and stay at the same level as before. So, so yeah, so that's that's about margin.
So, as per you, it is okay for beginners to use margin as long as they really understand the options before abusing margin account.
Exactly, because say you have a portfolio, and and you need some money, so you want to get some money from your portfolio. You just contact your broker and ask for a withdrawal. If you don't have margin, then you have to sell something, and you may not want to sell something at this particular time.
Makes sense. Makes sense.
Have
Now,
100,000, and so if
so
you
that
didn't have margin, you would have to sell something, wait for that to clear, and then once you have the cash in your account, then you can withdraw it. That could take a week.
makes sense. Absolutely, absolutely. So from, I think, from a beginner standpoint, but in any case, beginners, before getting into options, you should study options. Now, so we talked about cash. We talked about covered calls. We talked about put options. Selling covered puts, naked puts, covered calls, naked calls. We briefly touched upon the spread, both credit spread and debit spread. Are there any additional strategies do you think a beginner can use? Because most of the common beginner strategies I see, they people buy call options, and they say, I'm buying call, because that's a bullish framework. If you're
Right.
buying a put, it's a bearish. But I don't really see that. I see it depends upon how you look at the company. You are buying a put, it could be a bearish for the short term, but it could be bullish for the long term, because you eventually want to buy the put at a lower price, because the stock is going to go up in the long term.
Yes, that's definitely true. And I've had a lot of debate with Lucien Rojas from uh, Financial Empowerment with Brother Rowe, that he likes to buy calls and long dated calls, and he pays a lot of premium. And I say you could do the same by selling puts, long dated puts, because you get the premium. But if you think about it, you don't have to choose. They're both bullish strategies, right? You can do them both. I mean, here's the chart just for you to understand. If you buy a call, you're doing this.
Right.
If you're selling a put, you're doing this. So if you combine them, the premium you pay will offset the premium you receive plus the dividend. So in essence, what you're going to have is just being long the stock. When you're long the stock, the prices move up, you make money. If the prices move down, you lose money. So if you buy the put, if you sell the put, you get the commission, the premium, and you use that premium to buy the call, and then you're just buying the security without putting up the money. This is one of the strategies I recommend for not paying um, margin interest if you borrow against your margin account. A lot of people borrow or trade on margin. I don't advocate for doing that, especially in any material amount in relation to the value of your portfolio. But a lot of people do, and if they're going to do it, if they do this, buying the call and selling the option, then they don't have to pay the interest. They have the risk, because if the security moves down in price, they're going to lose money, but they don't pay the interest.
Got it. So this is very helpful. And so, Steve, have you had any experience with call options or put options? Have you used this in your investing
No,
strategy?
yeah. No, I haven't. But the thing is, and this is something maybe that Guillermo can explain to us, and that is the difference between what we've been talking about and shorting, because I understand there is a difference, and I've always had the two confused. So can you explain the difference?
Yes, absolutely. If you short a security, you have to borrow it from somebody else in theory, and you sell it in the open market, and you're hoping that the price of the security goes down so that you could buy it back from the market and return it to somebody that loaned it to you.
Right.
In practice, your broker dealer does all the borrowing for you.
Right.
So you just sell it. You tell the broker dealer, sell me this security. I don't have it. And you sold it short. If you buy a put, then you are also profiting from a bearish strategy. And you can, but you have to pay the premium, right? Another way of not of playing that without buying the shorting the security or buying a put is actually to sell calls. If you profit when the price on the line goes down because the call is going to expire worth, you get to keep the premium. Of course, you get only your profit is limited to the premium, and your exposure can be unlimited in theory.
So we have a question actually from Leroy from 40 and Broke. He asks, can you do a covered short?
A covered short?
Yes.
What do you mean?
I think he Leroy, maybe you can type it again in the are you referring to naked shorting and then talking about covered shorting? I haven't heard about the terminology covered short, but I know naked short exists.
Yeah, let me just take a crack at it. When you short a stock, okay, you borrow the stock and you profit if the price comes down. So one thing that you can do is you can actually buy a put to make sure that you can buy a you could let me see, let me think about that. When you sell short, it goes something like this, right?
Mm-hmm.
If this is 0 and 100, if the price goes down, you profit when you sell the stock, right? So what you want to do is you want to cover the risk, which is this one, of the price going up, right? So what should you do to cover that, to protect that? So perhaps buying a call. If you buy a call, it's something like this, and this will cancel that, right? So buying a call would protect you if you're shorting, if you have a short position.
I think Leroy is also asking this, can you short without margin?
No, you actually need a margin account to be able to short, because your losses are have to be measured, and the broker dealer measures your loss by your margin. Your losses are not indefinite; they are limited by the price of the security.
Right.
Okay, like.
So I have a question on that account. So let's say a person is using a margin account, right? And you have incurred a lot of loss, right? Now, let's say the total value of your portfolio is X, right? But your losses are X plus 1.
Mhm.
What is the broker going to do even after selling all your securities if they still cannot cover? Are they going to send you a letter saying, "Hey, you're missing that plus 1. We need that money from you"? How does that work?
Normally, the margin requirements are governed by Regulation T. You normally cannot have more than 50% of your portfolio on loan. So if it reaches that level, the broker dealer is forced to liquidate your securities and pay down the loan until it gets back in sync. Broker dealers normally can require more than Regulation T requires. So they are usually very conservative, and that situation where you're out your entire portfolio and you still owe money, it's very, very unlikely to happen in the future. But if it does, then you have an unsecured claim against that investor, and most likely the broker dealer is not going to be able to collect.
By the way, would that impact your credit score?
Well, certainly, if you have a debt, unsecured debt that is uncollected, would certainly impact your credit score. Yeah.
Got it. So I think for beginners, what we are at least learning here is that be very very careful when you're using margin account and doing shorting, um, without understanding the implication of what can happen to your portfolio, and especially if you have a very large portfolio, be very careful. We don't want to make a wrong move and actually end up liquidating. The broker dealer will force to liquidate it and you will lose a lot of money. So be very careful on that line. Now,
Right.
I know there are some very basic terminologies I think we should kind of touch upon for our audience and whoever is going to watch it later. Uh, in the money, at the money, out the money. Very, very basic terminology. Strike price, expiration date. Those are basic terminology. But can you kind of talk about the in the money, at the money, and out the money? What is that for investor who's just getting into options trading?
Yeah, the term at the money means that the strike price and the market price is the same. When the option is in the money, it means that the option holder has already a profit embedded into the transaction. If it's a call, it means that your strike price is below the market price. On the contrary, if it's a put, then it means if you're in the money, it means that the market price is low.
We have briefly lost
Yeah,
Guillermo.
just for a short while.
Yeah, he'll be back.
Yeah, he needs to get a Starlink. They're good satellites.
And for folks who don't know what Starlink is, Steve probably is going to make a video soon and explain. Is it just us who can't
Nice, because
hear?
he's in Puerto Rico. Did you know that?
Yes, I
Yeah.
heard. Yeah,
So
we had a brief chat before the
Oh,
live.
did you? Okay, yeah.
Yeah.
So Nora's online. Is she or she gone?
No,
She's
she's
still with
here.
us.
She's
Oh,
still with us, I think.
she needs to buy some Dunkin' Donuts for her coffee mornings.
Yeah, we
I
lost
told her this.
Guillermo for a brief. Yeah,
Yeah.
we'll hold
Yeah.
the fort while we wait for him.
Okay.
So I think Leroy is asking, did everyone watch the video put out today by Disruptive Wealth Creations and Finance ABCs?
Well, for those that haven't watched it, I did it on alternative meat. So it was all about Beyond Meat, Impossible Foods, and I had a young man called Dimitri from Mountain. So I always forget his name. It's Mountain Inspiration. Oh God, I need to find it on my iPad.
Oh, we are back.
We're back.
Guillermo is back with us. Sorry about that. Can you hear us?
I hear you. I'm sorry.
Okay, perfect.
I was just saying that, and
I think we are still having some technical difficulties. Oh, I think it's
right.
much better. No, I can hear you now. Perfect. Yeah. So we were talking about so we touched upon at the money where you said the market price and the options price, the strike price is the same. In the money is when the market price and the profit is already, the the seller of the option already has priced in the profit, and then out the money is what we were waiting for you.
Oh, sorry. The internet is not very stable, but I guess you can edit all these blips out. Anyway, yeah, if the put is in the money, then you have a profit embedded in your direction. So out of the money means that that the put is, or the call is going to expire worthless.
Got it.
And may not be exercised. When it's in the money, it's usually exercised.
Awesome. So we touched upon few beginner strategy. if a beginner is starting off, Guillermo, generally you have what, 2, 3, 4 levels of approvals for brokerage. Do you prefer any particular brokerage account which beginners should use for trading options, or it doesn't matter? You can go with whichever brokerage you want.
Yeah, whatever, if you have Robinhood, they have good option platform. I normally use Interactive Brokers because they charge some commission. It's a small commission, but they have very good execution, and the service quality is very good. But I also have a Robinhood account. I have a Webull account. I have accounts with Charles Schwab.
So we have a lot of accounts, and among all the accounts, let me ask you this, and it's a more of a UI question, user interface question. Which account do you find the most easy to deal with options? And then I'll give my feedback as well.
I think Interactive Brokers is the easiest for me, only because I know the platform. I've used it for a long time, and so I'm very familiar with it. But I've seen how Robinhood works, and it's very, very user friendly as well. You just swipe your phone, your intelligent phone. You travel from your phone.
So I have used Fidelity. I generally use Fidelity to write covered calls and some of those. And I actually do use Robinhood for options trading, and I have found it to be very user friendly. Webull, I find it a little bit more, I would say, complicated compared to Robinhood, not compared to Fidelity. Fidelity is a little bit more complicated, especially like when you're selecting a different strategies, you have to select a specific strategy. So it's like, in Robinhood, you can do a debit spread and credit spread. You can make an iron condor, and it will pick it up what you're doing it. In Fidelity, they only have 2 options, call and put. You have to select the strategy you are going to apply. So if you're doing an iron condor, you have to select iron condor and then do it. Otherwise, you will get an error. So I think the larger brokerages have a much more, I would say, steps by steps. So the SOP, standard operating procedure, is a little bit more difficult compared to Robinhood. Steve, I have a question for you. Have you had experience with options in terms of generating your income or writing call options? What is your experience with calls? Options.
Well, I haven't had any experience at all. But the only thing I have heard of is obviously Gamestop and how Robinhood have had some problems. And I just smiled when you mentioned Robinhood. And so you've had no problems with Robinhood when it comes to your call options. Then everything's been okay.
Well,
yeah, I have personally have. Sorry, Guillermo, go ahead.
No, yeah, with Robinhood, that GameStop issue was limited to those meme stocks that had such high volumes.
Right.
If you trade in Robinhood with stocks that have a lot of liquidity and the options have a lot of transactions, you shouldn't have a problem.
All right.
Okay. Just like Apple.
Yeah.
Yeah.
Just like Apple.
The other thing there was 2 more things I wanted to mention, and this is probably going a bit outside of what we're talking about. But obviously, with options, that doesn't affect the supply and demand of shares, but shorting does. If a lot of people are shorting, that can affect the price of shares. But I suppose it doesn't make any difference how many people are doing call options. That won't affect the price of shares. Am I correct?
Well, I don't think so. I think the price of the underlying is dictated by the supply and demand of buyers and sellers of that underlying. Mm-hmm. I know that there was some talk that the option activity was increasing the problem of GameStop, and I don't quite understand, how all that works. But in my opinion, it doesn't affect it.
Right. Okay.
Okay. So I think going back to our brokerages, so it's so for beginners who are watching after the live has ended, so it doesn't really matter which platform you're using it. Keep in mind the margin requirements. And also, I think for larger brokerages, I don't know, Guillermo, if you had the same experience, but in order to get level 2, level 3, level 4 approval, you need to have certain years of experience in the options trading before they grant you that. Have you faced a similar situation?
in my personal experience, it has never been a problem because I have been familiar with this for a long time.
Got it. So while we wait for
Yeah.
Guillermo,
Yeah.
Steve, are you planning to begin options trading? Is that something you
Um,
will be interested in?
maybe in a few months' time. I'm still warming to it. It may come at a later date, but it's not something that I'm sort of like I'm really proactively looking at. Um, I mean, I've been looking outside the share sort of stuff, and I'm actually in the crypto space. I'm looking at NFTs. I'm looking at maybe buying one or two. But yeah, I mean, it's good. It's good that there are lots of different sort of ways of investing with shares. Um, so yeah, it's very interesting.
So I can share while we wait for Guillermo to be back.
Yeah.
One of the ways you can grow your account
Hmm.
is to actually leverage option. And
Right.
oh, he's back. Perfect. Hi, welcome
Okay.
back. Okay. So I was just sharing with the audience is that one of the ways to build your wealth is also to use options, leverage options, and generate your weekly income or monthly income. A lot of people actually do that apart from dividend investing. So what are your thoughts, Guillermo, on that? Do you prefer weekly options or bi-weekly, monthly to generate income? What do you recommend?
In my preference is to sell long dated options, 6 months at a minimum, maybe a year down the road. Right now, I am selling options on the QQQ.
Hmm.
I have strike prices, in the 330, 340, 370 range. Um, so those expire in January, March, June. And I have been obviously some of these options that expire in January have been running for several months, so they're already in the money for me.
Mhm.
Um, I'm the seller, so that means that the option is out of the money. It's probably going to expire worthless.
Okay.
So
So Nora is asking us, Nora the Stock Explorer is asking us, give us all the details. So I think one of the, what Guillermo was mentioning was QQQ. So for folks who don't know QQQ, it's a NASDAQ ETF, QQQ.
yes,
And Guillermo, we can trade both ETFs as well as stocks in options. Is
right.
that correct? Okay.
And I prefer the ETF because the ETF is diversified. This SPY and the QQQ are my favorite to sell options on, put options, because I know that if there is an intermediate volatility event and the prices go down, I can roll forward my options, and eventually, it will be profitable. So
Great. So
individual,
we actually have a
individual,
question from, sorry, go ahead, Guillermo.
no, I'm saying individual stocks can go to zero. They can go out of business. I mean, companies that are very, very solid today can be out of business tomorrow. There's a million examples, but the one that comes to mind is Pan American Airlines. It was
Mm.
the leading airline in the world. It's out of business today. Woolworths, a very good, uh, retail store, is out of business. Toys R Us, J.C. Penney. I mean, you name it. There is
Sears.
Sears. I think it's still in business, but it's it's in shaky ground. But Lehman Brothers, was a leading broker dealer and is out of business.
So you prefer ETFs versus individual stocks. So we have few questions actually I want to take as well. So other kinds of money. Hey, welcome. Thank you for joining. He asked, when you sell, you have to own the underlying stock, right?
When you sell what?
Options.
No, not necessarily. You could sell a put and not own the stock. If you sell a call and it's a covered call, then you have to, by definition, own it. But if you sell it naked, you don't need to own it.
And I know you may have missed when we talked about this a little bit earlier, is you need to have a margin account to sell naked shorts.
Absolutely.
So keep that in mind. If you don't have that level of approval or the margin account, you would not be able to do it. The next question comes from Nora, the stock explorer. She said, do you still take a loss when you roll a losing option?
Well, you take a loss for tax purposes, but then you continue to you don't have a cash loss because the money you use to buy the losing option, you get it from the premium you receive for the new option. Let me see if I can explain that a little better. Suppose you have a timeline here. This is time, right? This is 6 months and this is 12 months. Suppose today you sell an option, a put option for 6 months, and at the 6 months, then the option is underwater, so you are taking a loss. Say at this point, close to the expiration, you buy back your losing option and you sell another one for 6 more months. And the premium you receive for this one will pay for the loss of the other one. Is that clear?
Nora, let us know if that answers your question. But I know since we are almost at the end of our live stream, and we'll take a few more questions if they come. But before we jump off, I want to ask you, Guillermo, for beginners who are just getting to learn options, what is your guidance or recommendation on how they should begin? Should they do paper trading, or if there's an option, I haven't seen one, if they can do options without using their own money to learn before they get into it? And yeah, so you get the gist of the question.
I think the good news is that you don't, if you're a beginner, you don't need to do options at all to be able to have a very successful investing career over your entire lifetime. All you really need to do if you're a beginner is buy the index, the QQQ or the SPY, buy it every month and hold it. And that's all you need to do. If you buy $100 a month, with Robinhood, you can buy fractional shares, $100 a month every month, and you're done. If you want to learn about options, I suggest you read about it, you watch YouTube videos on them, and start with a paper account and start trading and get to learn and understand it, because options can increase the yield on your portfolio and they can reduce the risk. For example, if you think that right now the stocks are a little bit on the high side, you can sell some calls against your portfolio, and that reduces the risk because the premium you receive can offset some of the losses if they do materialize. So don't do it with your entire portfolio. Start with maybe 5 or 10% of your portfolio. Of course, when you have a small portfolio, it's difficult because unless you're doing cheap stocks like Coca-Cola, if you're doing it on the index, you need at least $30,000 to do the option, and so your portfolio has to be $300,000 for you to be doing 10% of it. So start small, learn about it, play around with the paper account, and once you're confident, start writing some covered calls on a little bit of your portfolio, not all of it, so that you preserve the upside.
And if you are not sure what covered call is, definitely check out Guillermo's Finance ABC, and I'll put a link to my covered call video as well. So definitely check that out. Guillermo, are there any specific books you recommend or any specific YouTube channels do you recommend for watching, learning options, apart from yours?
Yes, I think best stock strategy is a good one. That's David Jaffe. He has a preference for selling options, and he has a lot of material for beginner investors. Um, um, there's also J.C. Gilbert. He's very good. He has some good insights and very good explanations. Um, so
That's awesome. And I think one of my last question was, um, Guillermo, in your personal experience of trading options for all these years, which has been your biggest success and the biggest failure, and what did you learn from them?
well, if you are in this business for a long time, as I have, you take you can show your scars, you take your losses in stride. But the biggest success is that over time, your portfolio goes up in value, and you may have some losses here or there, but you can't win them all. Just be resilient and continue to have faith that in the long term, the economy grows, and as the economy grows, stock prices are supported by those earnings of those companies.
Awesome. Steve, what are your thoughts? Any questions from your side for Guillermo before we
Well,
wrap
the,
up?
the, the only thoughts I've got are that they say that when inflation goes up, tech stocks go down. So maybe I need to start looking at puts.
I think actually inflation is good for stocks.
Okay.
The stocks, they actually increase the prices of their products,
Hmm.
on the and their earnings will remain, and so their prices are supported by that.
Hmm.
You know, some of the mistakes I've done, and going back to that question, I have been overly conservative a lot of my life, and that has proven to be a mistake. I have tried to time the market and thinking, I know better. I have been not as well diversified. Sometimes have too much in my favorite stock, and suffered for it. But these are lessons that you learn, and you improve every day. If you learn
And
from a mistake, it's not a total loss.
No.
I think the mistakes Finance ABC Guillermo is talking about is, I think all of us will agree that you know diversification is important, but don't make your portfolio like an ETF, right? Don't own 100 stocks, because then you can just own an ETF or an index fund. But this is amazing. This really, I think gives a very good overview of options. This was definitely in no way or form a course or anything. This was just to have a conversation from someone who has been doing options for many years, kind of understand, get his take on, how beginners can start off with options. We talked about certain strategies. We talked about what options are. We talked about some examples. Guillermo showed us, how that in the money, out the money works. We took some questions as well from the audience, and I mean, this is what we are. This was to give everybody some thought process, and it's a think about options as leveraging in your investment journey. This should not be your full-time only investment, but something to help you grow your portfolio. Now, I just want to I know we're a little bit over time. Any closing thoughts, Guillermo, from you, Steve, and then that would be our before we leave.
Okay, well, from me, I just want to say quickly that it's been very informative. I've really enjoyed it. And Guillermo, a big thumbs up from me for a very good video. Thank you.
Yes, and for me, again, if you're a beginner investor, don't be overwhelmed by all these option talks. Um, know that if you just invest in the index every month and hold, you're going to do very, very well in the long term.
That's it. And the same from me. I think we have some, some experience here, which is talking. And for beginner investor, if you are in your early 20s or you're a teenager, or even if you haven't started investing, whichever your age is, I think learn from experience, and as you see more videos from other content creators or you read books, these are some time tested strategies. Buy and hold, or nowadays we call as hodl. Whatever you like it, you like hold, you like hodl, doesn't matter. End of the day, that is what investing is all about. Over a long period of time, the stock always goes up. That is historically true. And always think about it. If your favorite stock goes down, which is you have an index fund to also fall back upon. And let me see if we have any questions. So we have other kinds of money. Appreciate you guys from helping me not gamble on options anymore. I hope this discussion was helpful. Debt-free that, investing over 15 years and never did an options contract. LOL. I'll do one soon, possibly. Definitely check out the channel from Finance ABC, Guillermo, and I think it's a very, very informative. And Steve, he runs a disruptive wealth creation channel, talks about a lot of growth stocks. So definitely check out all these channels. The link will be in the description. Thank you, folks, for joining today. It was a wonderful conversation. I really learned a lot, and I hope our audience who were with us today and who's going to watch this afterwards. So thank you so much for joining today.
All right.